Welcome back. We are now moving into chapter 4, which is the general journal and the general ledger. This visual shows you what you have learned so far in the last 3 chapters. We learned how to analyze transactions using the accounting equation both in basic and expanded form. We learned about debits and credits. One critical point to remember about debits and credits is that debit does not mean decrease and credit does not mean increase. We learned that debit is left and credit is right. As you can see from this visual, debits and credits can both increase or decrease depending on the account that we are dealing with. It depends if the account is an asset, a liability, or part of owner's equity. And we learned how to record transactions in tabular form. And last week we learned how to record the transaction in account form or T accounts. This visual shows you where we're heading next. As you can see, we're always given information about a transaction. It's at the top. We analyze a transaction to determine the accounts that are affected within the accounting equation, and we record the transaction in tabular form. We then learned how to determine if the transaction is a debit or credit, which is right here. And based on that analysis, we learned how to post a transaction on a T account, which is at the bottom. What we will be doing now is we will be moving into journal entries, which is where you see this red arrow going into. A journal is a diary of business activities. It's a place where transactions are recorded in chronological order. A general journal is a financial record for entering all types of business transactions. So journalizing is a process of recording transactions in the general journal. So for the last 2 weeks, I have been showing you the concepts of tabular form and T accounts using the same transaction information at the top. I'm going to continue with the same transaction information so that you can see the pattern. The first transaction that we dealt with was an investment by the owner for $30,000 to start a restaurant business. And we learned that it affects 2 accounts. It affects the cash account and the owner's capital account. We recorded this in tabular form, which is right up here, and also in T accounts, which is at the bottom. And we did that by determining if it was a debit or a credit. What we determined last week is that investing $30,000 in cash to open up a restaurant business was going to increase the cash account. So, if you look at the assets where cash belongs to, in order to increase that account, you need to debit. Okay, so we record it as a debit or on the right side of the T account or the cash account, okay? So that's where we recorded here on April 1st on the debit side, on the left side under the cash T account. And we determined that the investment will also increase owner's capital, so that will be recorded as a credit on the right side of the T account under the owner's capital account. And that's based on this visual here for owner's capital. In order to increase owner's capital, you credit that particular account. Now, what we will learn this week is how to journalize an entry. We are going to follow the same concepts to determine which accounts are affected within the accounting equation, and also to determine if it's recorded as a debit or credit. Same process. The only difference is the format or the way that we record it. And so the bottom part here is what the general journal looks like. That's how we will be recording it when we need to journalize. Think of it as an Excel spreadsheet. We have a column for the date of the transaction. We have a column for the account titles and an explanation. We have a column for debit and we have a column for credit. So we know that when an owner invests cash money into the business, it is going to affect the cash and the owner's capital account. We determined that for the last 2 weeks. And it'll be the same procedure now for that same type of transaction. It'll affect the cash and the owner's capital account. We also know that this investment will increase the cash account, so it will have to be recorded as a debit. We will still be using this visual to determine that. So when we journalize, we always record the debits first and the credits next. Okay? So now, not only do we know that a debit is left, we now know that the debits are recorded first when we journalize. Likewise, not only do we know that the credit is right, we know that credits are recorded after debits when we journalize. So, the way that we journalize this transaction is by first recording the date. From the last transaction, we knew that it happened on April 1st. So we recorded as is. Now, we debit or increase the cash account. So we record the title as cash. And we record $30,000 on the debit column. Next, we record the credit, which in this case is owner's capital. And we record $30,000 under the credit column. Now, notice that the credits are indented a little bit to the right. See the difference between the debit, which is on the left-hand side, and then there's an indent on the credit side. This will always be the case for credits, okay? When you record your credits, you will indent it. And the last step is to provide some type of explanation so that we know what the transaction was for. And that's this bottom line here. In this case, I wrote owner invests in restaurant. There's no right or wrong answer. You just need to make sure that you record a description that will help you remember what the transaction was all about. And that is it. We just learned how to journalize an entry. The second transaction consisted of the owner buying equipment for $10,000 in cash. And we learned from the last 2 weeks that this transaction affected the cash and the equipment accounts. And we recorded the equipment as a debit. And we recorded we credited the cash account since a credit decreases the account. Okay? That's what we learned last week. Now, to journalize this, which are the concepts for this week, we record the date. In this case is April 2nd. Then we record the debit first, which is the equipment account. And we record it as $10,000 under the debit column. And next we deal with the credits. In this case, cash. We record it under the account column, indented to the right, and we record $10,000 on the credit column. And the last step is to add an explanation, which in this case I just put to purchase equipment. This is very generic. Of course, if you know what type of equipment you purchased, you might want to add that description. Perhaps it was a blender, then you will add to purchase equipment slash blender. Whatever will help you understand or remember what the transaction was for. So this is what the general journal looks like so far. I presented the last two examples separately, but when you record it in the general journal, it's in one place. So in this case, it has two transactions that consists of the owner investing money, that's the first one, into the business, and then recording the purchase of the equipment. And as more and more transactions occur, this journal will get longer and longer. What I'm going to do for this week is add a third transaction. And I'm doing that to show you how to record what we call compound entries. Compound entries is a journal entry that affects more than one debit or credit. So in this example, the owner buys supplies for $5,000 and pays for it using $1,000 in cash and $4,000 on credit. So now we have transactions that affect 3 accounts, not 2. In this case, it affects the supplies account, the cash account, and the accounts payable account for credit. And so we journalize this entry in the same manner as the previous examples. We record the debits first, so we know that it happened on April 3rd. And supplies, in order to increase that account, if you look at assets, to increase that account, we record it as a debit. And that is because we're increasing the supplies account, which is an asset. And then we determine the credits. So we have a debit for supplies for $5,000. That is to record the purchase of the supplies for $5,000. Then we determine the credits. In this case, both cash and accounts payable are recorded as credits. We are paying supplies with cash, so in order to increase our cash account, we must credit the account. Okay? And that's because we are decreasing our cash account. We're paying $1,000 out of our cash account. So we record that as cash, indented to the right because it's a credit, and we record $1,000 under the credit column. Now the remainder of the balance is paid using a credit card, so we know that that's a liability. And the liabilities is on pink. And we know that because we are owing money to the creditors. So in this case, the account under liabilities is the accounts payable account. And in order to increase the account, we need to credit the account. So we record that as a credit, as accounts payable, indented to the right. And we record $4,000 under the credit column. And lastly, we add an explanation, in this case, to buy supplies, and we're done. Nothing drastically different. The only difference is that we have 3 lines under this journal entry. This is what the general journal looks like after the third transaction. As you can see, this general journal is getting much longer. Now we have 3 transactions here for 3 different dates. Now remember that every time that there is a transaction, the accountant has to record it on the general journal. And imagine yourself as an accountant, and imagine how massive this journal will get in a month. It will be massive with many transactions. Do you think that this is an efficient way of keeping records? Do you think that you would be able to determine how much cash you have in the cash account by looking at the general journal? Well, I think that eventually you will be able to determine the amount of cash, but it will certainly take you a long time to do that. It's time consuming. So, this is where the general ledger comes in. A general ledger is the master reference file for the accounting system, and it provides a permanent record for all accounts used in the business operations. So, what this visual is showing you a transaction that is recorded as a journal entry, just like we just learned in the previous slides. And it's recorded as a journal entry in the general journal. It was an investment by the owner to the business in cash for $15,000. So it affected the cash account and the owner's capital account, just like our first transaction that we have been dealing with. What the general ledger does, now follow these red arrows, what it does is it keeps separate records for different accounts. It keeps all transactions affecting the cash account in the general ledger for cash. And likewise, it keeps all the records affecting owner's capital in the general ledger for owner's capital. And what it does, by separating each account into its own ledger, it will allow you to keep up with the balances of each account. So instead of going through hundreds or maybe thousands of journal entries in the general journal, you can now go to the general ledger under cash, for example, and see all the transactions affecting cash and see the balance of that account. And you could do the same for the other accounts. This is what the general ledger looks like for the 3 transactions that I just presented to you. Okay, and in order to show you how I got to this point, what I'm going to do is exit this PowerPoint and I'm going to split my screen so that you can see step by step how to complete the general ledger. Okay, let's see if this will work. Okay, I hope that this is big enough for you to see from the equipment or laptop or computer that you're using to view this PowerPoint. This on the right hand side is your general journal. This is all the 3 transactions that occurred during 3 days. And as you can see, it affected various accounts within the accounting equation. We have the cash account, the owner's capital account, the equipment, we have cash again, we have supplies, and then we have cash again, and accounts payable. And so what we're going to be doing in order to transfer it to a general ledger, we are going to be separating all the transactions that are similar to one account and placing them into one account here. Okay? And eventually when we do that, we are going to get this result. So now I'm going to go to a blank one so you know how I got there. What we're going to be doing is transferring all this information and separating them out into different documents for each of the accounts. Think of it as your bank accounts. You have a checking and you have a savings. Think of each one of these, and perhaps this is your checking account and this is your savings, and perhaps you have a liquids account. Instead of having one statement coming from the bank that it's all over the place in chronological order based on which account you used, we're going to be transferring all this information and separating it out based on which account it affected. So we start by April 1st. We have affected the cash account as a debit for $30,000, and that's because there was an investment in the restaurant. So the way that you're going to transfer it in the ledger is you're going to set the date. The explanation in this case is going to be owner investment. And we know that it's a debit for $30,000, so we are going to keep it as is. And now the difference between the general journal and the ledger is that we now have another column called balance. This is just like your statement from the bank. Every time you purchase something, it'll tell you how much it decreased your account, and it gives you the new balance. Or if you deposited money into your account, it shows you the new balance after that deposit. Same concept here. We have a debit for $30,000, so we know that we have $30,000 in that account. Then we look that we have, on the same day, we have a owner's capital transaction, which is a credit for $30,000. So you're going to go to your owner's capital general ledger and transfer that information. In this case, it was an owner investment, right? Owner's capital it happens when the owner invests money. So we will put in the same explanation. But we're going to record this as a credit because that's what it shows here. And we're going to give in the new balance. Now on April 2nd, the equipment account was affected by a debit of $10,000. And that was because we purchased equipment. So we're going to go to the equipment general ledger, transfer the date, transfer the explanation. The explanation is going to be purchased equipment. And it's going to be for a debit of $10,000. And we transfer that into the balance. Now we have another transaction that affects the cash account, and that's a credit of $10,000. So we're going to go to our cash general ledger, excuse me. In this case, it happened on April 2nd, and that was due to a purchase of equipment. So I'm going to put down paid equipment because that's what we're doing. We're paying, and it was a credit of $10,000. So now we no longer have $30,000. We actually paid something for the amount of $10,000, so our new balance is $20,000. Then on April 3rd, our supplies account was affected. There was a debit of $5,000. So we go to supplies, we log it in as April 3rd, and that was because we purchased supplies, so purchase supplies. And that was for $5,000, so our new balance is $5,000. And then we paid part of that $5,000 in cash for $1,000. So we go up here and we record on April 3rd, we paid for supplies in the amount of $1,000. So now our new balance here is going to be $19,000. And then lastly, we have our accounts payable, and I have it down here. That's because we paid part of those supplies on credit for $4,000. It happened on April 3rd. Paid for supplies, and that is for $4,000. So our new balance is $4,000. And we're done. What you can do is at the end, you could just put $19,000 just to separate out the actual balance on each account. Okay, in this case, I need to make it a little bigger. Okay. This one's $5,000. This one's 4. And we are done. We recorded all of the general journal transactions into the general ledgers. And that is all the concepts that you will learn for this chapter. It's journalizing the entries, and once you journalize them, transfer them into the general ledger. If you have any questions, please let me know. You know where to find me. Good luck to you.